aggressive US tariffs and a cautious Fed are reshaping India's investment environment and precisely how you should pivot your portfolio. Hi, this is Prabhanjan Rao from Elysian Investment Advisory. We are a SEBI registered investment advisory providing curated solutions for long-term wealth creations. So stay with me, stay tuned because logic beats hype every time. Disclaimer: the following content is only for informational and educational purposes. It should not be construed whatsoever as an investment advice. Please do consult your financial advisor before making any investment decisions. Here's what we are going to discuss on today's episode: US tariff shock and India's GDP headwind, US EU trade deal and India's diplomatic isolation. Number 3, Fed policy and labor market signals. And number 4, last but not the least, what Indian investors should do this week. So do subscribe to my channel and watch till the end. Fed policy and labor market signals. The Fed held rates steady at 4.25 to 4.5%, but two dissenters signaled a split. July jobs report showed a slowdown, only 73,000 new jobs added. Unemployment kicked to 4.2%. Markets are now pricing just one rate cut by the end of 2025 with easing delayed until mid-2026. What does this mean for India? Higher for longer, US rates strengthen the dollar and keep bond yields elevated. This means capital outflows from emerging markets like India continues. The RBI worry of imported inflation and rupee weakens is unlikely to cut rates soon. What is Elysian's stake in this? Tight global liquidity and policy divergence will keep Indian markets volatile. Prepare for short-term shocks but focus on long-term fundamentals as we always do. US tariff shock and India's GDP headwind. August 1st marked a turning point. The US slapped a 25% tariff on multiple Indian exports from apparel to pharmaceuticals. At this juncture, we are not yet clear which sector or which set of goods are getting impacted because of this US decision of 25% levy. This is not a major tweak, it's a seismic shock impacting nearly 87 billion worth of goods. To set in context, that's about 18% of India's total exports. Let's break it all down. Who's really hit? Apparel exports to the US are about 18 billion annually, and tariffs make these goods more expensive, reducing competitiveness. Gems and jewelry. A 12 billion industry concentrated in Surat and Mumbai faces a 25% price hike for US buyers. Pharma exports to the US worth around 20 billion, especially generic drugs. These face increased costs and potential order cancellations. Auto components and electronic exports making up nearly 6 billion, and they are squeezed as well. Now, what is its economic impact of US tariff shock? This tariff move could shave 30 to 40 basis points of India's GDP's growth in FY26 according to trade economists. Why? Because exports drive manufacturing jobs, foreign exchange inflows, and investors' confidence. Lower exports mean factories slow production, some may even reduce workforce, and foreign institutional investors become wary, potentially triggering capital outflows. See, look at what happened in the markets. On the tariff day, the Sensex fell roughly 0.7%, Nifty dropped 0.8%. Foreign institutional investors pulled out a staggering 27,000 crore over 9 days, a sign of global risk aversion. The rupee weakened sharply from 87 to 87.6 against the dollar. These moves reflect how deeply investors are pricing in the economic damage and uncertainty. For investors, this tariff shock demands a rethink. Export-heavy mid-caps and niche pharma stocks could see a margin compression and volatile earnings. Again, at this juncture, we are not clear which sector or set of goods are going to hit by these 25% tariffs. Conversely, companies focused on the domestic market or those with diversified global footprints may prove more resilient. The broader economic growth story is intact but slow in the near term might be there, making sector rotation a critical tool. US-EU trade deal and India's diplomatic isolation and how it impacts on Indian markets. The US-EU trade deal signed on July 27th capped tariffs at 15% and secured $600 billion in the EU investment into American infrastructure, autos and tech. Japan and UK got similar deals. India left out. Why? The US wants India to reform agriculture and digital trade rules. India refused. The price? A 25% punitive tariff with no relief in sight. This deepens India's isolation in global trade frameworks, making capital flows and export growth more uncertain. What is Elysian's insights in this? India must engage diplomatically, but also double down on sectors insulated from global shocks such as infrastructure and banking. What investors should do this week? Reduce exposures on these areas. Exporters hit by tariffs in dealing in gems, textiles, niche pharma. They face margin pressure and order cancellations. Hold or neutral. Large cap IT, FMCG and consumer durables with strong domestic demand, but watch valuations. And where should you be overweight? Infrastructure, defense, private banks and consumer discretionary stocks, because these benefit from government capex and robust domestic consumption. Key watch factors during this week: upcoming US inflation data and payrolls, RBI FX interventions as the rupee tests very new lows every day. Next, US-India trade talks expected in early August. So, stock market enthusiasts, this week's turmoil isn't accidental. It's a calculated reshaping of global trade and monetary policy. India faces a dual challenge: external tariff shocks and tighter global liquidity. But with the right focus on domestic demand, infrastructure and banking, there is ample and plethora of opportunities. Stay logical, disciplined and data-driven. I am Prabhanjan Rao from Elysian Investment Advisory. Subscribe for sharp expert insights every week. Invest smart and I will see you next time. If you like this video, please do subscribe, like and comment. Have a super Elysian day.